In this video, traders, we're going to look at what lessons can we take from the 2008 crash that might prepare us for an upcoming one. Stay tuned. Hey traders, warm welcome to you. Okay, 2008 crash, pretty brutal, took out a lot of people, took out a lot of businesses. We know the score, not going to go over things, but the thing is, can we learn lessons from the 2008 crash that we can take and perhaps utilize if we come up to another crash? Now, I'm not going to stand here and say, hey, we're going to have a crash, hey, we're going to have a downside, we're going to have this. We could have another 10 years of bull market, we could start a bear market tomorrow. We don't know that. It's not about predicting, it's about being prepared. If you are fully invested, you're enjoying the bull run, you're making money out of it, that's all very well and good, but having a plan and being prepared for if something does happen means that you can keep those gains rather than giving it all back and feeling super frustrated, because there's nothing worse than making an awful lot of money and giving it all back. I know multiple stories of guys who in 1999 or even 2008 who made a lot of money doing the right thing in a bull market, adding on dips, leveraging themselves right up, riding the wave, becoming very wealthy on paper. And then when the rug was pulled, they didn't have a kind of backstop or stop loss in place, gave it all back, in some cases more. So avoid that. How do we avoid that? Look at number one, remove the noise. So the first thing you need to do is when you're looking at whether the market may crash. Now, hey, we might not get a crash as such. We might get a drift down. We might go into a slow drift lower that stagnates for a long time and does nothing in the market. We've had periods of that before where we've just sat in the market. It's been quite a bit off the highs, but just sat there and done nothing. We've had brutal down moves that have picked back up quickly. We've had brutal down moves that have stayed low and then picked back up. You've got to be prepared for all of it. So the main thing is just to stop listening to all the financial media and reading articles on people's opinions. That's all it is. People giving opinions. It's like, hey, you look like a guy who's got an opinion. Come on here, talk about why you think the NASDAQ is going to crash. Why you think the SP 500 is going to rally for another 10 years. It's irrelevant. They're just filling media space, guys. We know that, you know that. So don't listen to it. You know, don't let them adjust your opinion or help you form your opinion. You know, you need to be looking at objective observation. So what's happening? So if you are a global macro kind of guy and you're looking at all the things, what's happening out there? Are there any warning signs? Maybe there are multiple warning signs, but the market's still chugging up. And so you say, okay, well, I need to be more prepared now because a catalyst could come out that might trigger an event, a catastrophe. Or you might say, hey, this is such a robust market, we're riding on. But the point is observing objectively rather than panicking, rather than doing stuff you don't want to do, which brings me very nicely to this one. And I think this is the most important one out of all of them. And even from a trader's perspective, from an investor's perspective, having a solid plan will help you regardless. So the easiest plan to do is to say, two broad plans you've got. One is, and I'm not really swearing at you, two broad plans you've got is, one, to hold everything. You hold everything, you carry on with the strategy, your dollar cost averaging, you're adding some money per month into your portfolio. You carry that on because you've got a 20-year, 50-year view, whatever it is, it's to leave to your children, it's a legacy, fine. Or you might say, you know what, it's something I need to access pretty soon. I've got a decent amount there. I don't want to give it back. And so you have a plan to exit. And that might be almost a trading stop loss on your portfolio valuation. So say it's valued at 900,000. Now you might say, you know what, I'm prepared to have it drop to 750 and then I want to cash out because I've earmarked that for other stuff. Whatever, you get the point. So I'm being very broad there, but having a plan of action means that when something happens, you are not stuck like a deer in headlights. So in other words, if you've said to yourself, you've sat down, you've consulted whoever you need to consult with, whether it's a family portfolio or if it's just yourself, and you've said, hey, you know what, we're investing for the long term. So whatever happens in the market, we will still continue to buy and drip feed money into the market. And then when the market, if the market falls down and crashes, you know what you're doing. You're not going to get spooked out. You say, hey, we said we're going to do this. We're going to ride out the storm. We're going to keep adding into the market. Fine. Or Vice versa, you say, hey, you know what, we need that money, and means you're not going to start adding. You're not going to, if the market starts falling down aggressively, you're not going to start adding and say, hey, not adding, I'm waiting till that point. If it doesn't hit there, fine. If it does, I'm liquidating everything, I'm cashing in what I've got. I've had a good run out of it. The point is to have that strategy. Same with whatever you're doing in the market. Okay, don't keep looking at P&L. Obviously, if your plan involves looking at P&L, do that, but don't let that drive your decision-making process if you haven't already planned it. So too many people, that's why they liquidate the bottom. They see the hammering down, they go, oh man, it was double that before, oh gosh. They pull the rug, they can't bear thinking of that being halved again, and it's normally the kind of peak fear. They sell everything, and then what happens is the market climbs back up, and then they're stuck. Do they chase it, do they not? So don't let that fuel your decision-making unless you've put it as a parameter as part of your plan. Okay, number 5, buying solid companies. If you look at when we've had this kind of shudder in 2008, the good companies are the ones that recover quickly, ones that are making money, they're solid, they've got good assets, they're not vulnerable, they're not leveraged up, they've not got no massive debt, all the kind of stuff we know, look for in a good company. Buying good solid companies will help you ride out the storm and help get a good recovery when you do. If you do get a good recovery off the low. Number 6, remember the next crash may be different. So everyone is planning for what happened before, and inevitably things change. If you look at just history in general, look at the way wars are fought. Everyone prepares for how the last war was fought. Even things like terrorist attacks, everyone's preparing for another method that the terrorists used last time, and then they use something different. They use something different, and then we're chasing our tail. So similar. Bad analogy, but you get the point. I'm not comparing a market crash to a terrorist attack or a war, but you get the idea, is that preparation for what happened previous might not help you to what happened now. So it's thinking ahead and thinking what could happen, what could be the catalyst, where could it be triggered, what are the warning signs, what I've got to look for. Maybe it's not housing this time, maybe it's this, maybe it's that, maybe it's something else, whatever it may be. And just remembering that history doesn't really kind of do the same thing. It will do a little bit of a flavor of what it did. Number 7, stick to your plan. So if you have got a solid plan, which you should do regardless, is stick to your plan. If 2008 you did it right by holding, fine. Maybe this is going to be different. Maybe you're going to end up pushing to highs. Whatever it may be, have a plan is the best thing you can do. You can be prepared for it. You can look out. You can observe objectively. Stop listening to the noise. Stop listening to all that. Sit down, write your plan out, laminate it, whatever it needs to be done, tuck it away and say, you know what, if this happens, I know how to act. I'm protected. I'm happy. I'm comfortable.